Hi, I'm Larry Shover, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago. You know, I get the sense that people are generally disappointed with the market as of late. Let's put it all in context, though. I think that's really important. It is true, early September, the global equity market was up about 15% on the year, but let's put it into context. I mean, the market didn't belong up 15% given the severe amount of headwinds we've faced. Now that the global equity market's up about 6-7%, we should view that as a tremendous victory given the problems we're having in the U.S. with the fiscal cliff, giving Europe, Spain, Greece, what have you. 6-7% makes sense. And also keep in mind it also bodes to the fact that we should stay with normal, maybe near normal allocations, because slow and steady does win the race, and coast is clear investing never wins the race. Let's look at volatilities. What has been the theme as of late, maybe in the last 6 months with volatilities? Volatilities do tell us things that the markets might not tell us. The first thing is that volatilities are generally very, very cheap, not just looking at the equity vols, but when you look at FX vol, metals vol, oil, everything else, interest rate, I mean, volatility basically has been sucked out of the market. That might be telling us something. Also, with equity market in particular, skew is very cheap, and it really has been on the cheap side of history most of the year. And for most of you who don't know, skew is basically the price people have to pay for out-of-the-money puts versus the equal-distant out-of-the-money call. So puts have been cheap relative to history. Also, we just need to look at some of the other things where equity vol compared to index vol has been very, very highly correlated. And what that's saying is that both of them have been cheap, but you're probably better off hedging with index vol. So going on, like what's baked into the market right now? What's volatility saying to us? And I think the first thing is that with the fiscal cliff issue, we're beginning talks today, but I think there'll be a lot of horse trading, a lot of political positioning, but something will get figured out. I mean, the market does know that if everything gets expired, if we do fall off the cliff, that would be a 4% of GDP, not good for the market, and that would create a negative shock for everything. But somehow volatility seems to take comfort in the fact that something will get figured out. How about Greece? I mean, the market has to know that 180% debt to GDP ratio is just not sustainable. And no matter what happens, the EU, the IMF, the ECB, whomever is going to have to take a debt write-down. I mean, I think the market is implying that. The newspapers surely aren't, but I think volatility is telling us that that's going to have to happen. And on to China. I mean, China is stabilizing. I mean, we've seen numbers get better there, not great, but better, and GDP there is about 8%. So I think the markets are pricing that in. I mean, do volatilities ever lie? Sure they do. I mean, it happened last year in August when we lost our credit rating. I mean, it did catch the market by surprise, but generally speaking, volatility does somehow just have collective wisdom and doesn't really lie altogether. So at the end of the day, like, how do we play this? I mean, what's the normal thing to do here? And I think first we have to understand that planning for Armageddon or coast is clear investing never makes sense. You have to stay in the market, and if you want to be a little bit lower than normal allocation, that's fine. Secondly, you really need to hedge. I'm a very conservative investor and trader. I think hedging always makes sense, but especially in this environment with volatilities being so cheap, a great time to be hedging your downside exposure. I think the last thing is managed futures. An allocation to managed futures does make sense. They've gone through a severe drawdown, but if you look at history, managed futures over the long haul does reduce portfolio vol and enhance returns. But again, that's over the long haul. And just so you know, managed futures up until about 2008 were really only reserved for the high net worth, the institutions, or the pensions. But most recently, there's been about 25 to 30 SEC approved managed futures mutual funds that take advantage of trends in the marketplace. It's not the latest best thing. It's been something that's been around for a very long time, but now is available to the retail investor. But again, it's not something that you just buy and sell over the next week or month. It's something you put purposefully in your portfolio to help reduce portfolio volatility. I'm Larry Shover, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago.